Hi everyone, good morning. So we are now in chapter 12 with the topic differential analysis, the key to decision making. So before we start, let me first read to you the learning objectives. First, identify relevant and irrelevant costs and benefits in a decision. Second, prepare an analysis showing whether a product line or other business segment should be added or dropped. Third, prepare a make or buy analysis. Fourth, prepare an analysis showing whether a special order should be accepted. Fifth, determine the most profitable use of a constrained resource. Sixth, determine the value of obtaining more of the constrained resource. Lastly, prepare an analysis showing whether joint products should be sold at the split-off point or processed further. Managers must decide what products to sell, whether to make or buy component parts, what prices to charge, what channels of distribution to use, whether to accept special orders or special prices, and so forth. Making such decisions is often a difficult task that is complicated by numerous alternatives and massive amounts of data, only some of which may be relevant. Every decision involves choosing from among at least two alternatives. In making a decision, the costs and benefits of one alternative must be compared to the costs and benefits of other alternatives. Learning objective number 1. Identify relevant and irrelevant costs and benefits in a decision. Every decision involves choosing from among at least two alternatives. Therefore, the first step in decision making is to define the alternatives being considered. Once you have defined alternatives, you need to identify the criteria for choosing among them. First, relevant costs and relevant benefits should be considered when making decisions. Second, irrelevant costs and irrelevant benefits should be ignored when making decisions. Lastly, identifying relevant costs and benefits. Only those costs and benefits that differ in total between alternatives are relevant in a decision. If the total amount of a cost will be the same regardless of the alternative selected, then the decision has no effect on the cost, so the cost can be ignored. To elaborate on this point, we'd like to define the terms avoidable cost, sunk cost, and opportunity cost, and illustrate the concept of future costs that do not differ between alternatives. The key to effective decision making is differential analysis, focusing on the future costs and benefits that differ between the alternatives. Everything else is irrelevant and should be ignored. A future cost that differs between any two alternatives is known as a differential cost. Future revenue that differs between any two alternatives is known as differential revenue. An incremental cost is an increase in cost between two alternatives. An avoidable cost is cost that can be eliminated by choosing one alternative over another. Sunk costs are always irrelevant when choosing among alternatives. Sunk cost is a cost that has already been incurred and cannot be changed regardless of what a manager decided to do. Sunk costs are always the same no matter what alternatives are being considered. Therefore, they are irrelevant and should be ignored when making decisions. Future costs and benefits that do not differ between alternatives are irrelevant to the decision-making process. Opportunity costs also need to be considered when making decisions. An opportunity cost is a potential benefit that is given up when one alternative is selected over another. Opportunity costs are not usually found in accounting records, but they are costs that must be explicitly considered in every decision a manager makes. To summarize, only those costs and benefits that differ between alternatives are relevant in a decision. Differential costs are also referred to as relevant cost or avoidable cost. The key to successful decision making is to focus on relevant costs and benefit as well as opportunity costs while ignoring everything else including sunk costs and future costs and benefits that do not differ between the alternatives. In different costs for different purposes, we need to recognize a fundamental concept from the outset of our discussion: costs that are relevant in one decision situation are not necessarily relevant in another. This means that managers need different costs for different purposes. For one purpose, a particular group of costs may be relevant. For another purpose, an entirely different group of costs may be relevant. Thus, each decision situation must be carefully analyzed to isolate the relevant costs. Otherwise, irrelevant data may cloud the situation and lead to a bad decision. The concept of different costs for different purposes is basic to managerial accounting, so we have here an example in identifying relevant costs. Cynthia is currently a student in an MBA program in Boston and would like to visit a friend in New York City over the weekend. She is trying to decide whether to drive or take the train. Because she is on a tight budget, she wants to carefully consider the cost of the two alternatives. If one alternative is far less expensive than the other, that may be decisive in her choice. By car, the distance between her apartment in Boston and her friend's apartment in New York City is 230 miles. Cynthia has compiled the following list of items to consider. Which costs and benefits are relevant in this decision? Remember, only those costs and benefits that differ between alternatives are relevant. Everything else is irrelevant and can be ignored. As you can see in the table, Item A, the original cost of the car, is a sunk cost. This cost has already been incurred and therefore can never differ between alternatives. Consequently, it is irrelevant and should be ignored. The same is true of the accounting depreciation of $2,800 per year, which simply spreads the sunk cost across 5 years. Item B, the cost of gasoline consumed by driving to New York City, is a relevant cost. If Cynthia takes the train, this cost would not be incurred. Hence, the cost differs between alternatives and is therefore relevant. Item C, the annual cost of auto insurance and license, is not relevant. Whether Cynthia takes the train or drives on this particular trip, her annual auto insurance premium and her auto license fee will remain the same. Item D, the cost of maintenance and repairs, is relevant. While maintenance and repair costs have a large random component, over the long run, they should be more or less proportional to the number of miles the car is driven. Thus, the average cost of $0.065 per mile is a reasonable estimate to use. Item E, the monthly fee that Cynthia pays to park at her school during the academic year, is not relevant. Regardless of which alternative she selects, driving or taking the train, she will still need to pay for parking at school. Item F is the total average cost of $0.619 per mile. As discussed above, some elements of this total are relevant, but some are not relevant. Because it contains some irrelevant costs, it would be incorrect to estimate the cost of driving to New York City and back by simply multiplying the $0.619 by 460 miles or 230 miles each way, 332. This erroneous approach would yield a cost of driving of $284.74. Unfortunately, such mistakes are often made in both personal life and in business. Because the total cost is stated on a per mile basis, people are easily misled. Often people think that if the cost is stated as $0.619 per mile, the cost of driving 100 miles is $61.90, but it is not. Many of the costs included in the $0.619 cost per mile are sunk and or fixed and will not increase if the car is driven another 100 miles. The $0.619 is an average cost, not an incremental cost. Beware of such unitized costs, such as cost stated in terms of a dollar amount per unit, per mile, per direct labor hour, per machine hour, and so on. They are often misleading. Item G, the decline in the resale value of the car that occurs as a consequence of driving more miles, is relevant in the decision. Because she uses the car, its resale value declines, which is a real cost of using the car that should be taken into account. Cynthia estimated this cost by accessing the Kelley Blue Book website. The reduction in resale value of an asset through use or overtime is often called real or economic depreciation. This is different from accounting depreciation, which attempts to match the sunk cost of an asset with the periods that benefit from the cost. Item H, the $104 cost of a round-trip ticket on the train is relevant in this decision. If she drives, she would not have to buy the ticket. Item I is relevant to the decision, even if it is difficult to put a dollar value on relaxing and being able to study while on the train. It is relevant because it is a benefit that is available under one alternative but not under the other. Item J, the cost of putting Cynthia's dog in the kennel while she is gone is irrelevant in this decision. Whether she takes the train or drives to New York City, she will still need to put her dog in a kennel. Like item I, items E and L are relevant to the decision, even if it is difficult to measure the dollar impacts. Item M, the cost of parking in New York City is relevant to the decision making. Bringing together all of the relevant data, Cynthia would estimate the relevant costs of driving and taking the train as follows. What should Cynthia do? From a purely financial standpoint, it would be cheaper by $33.86 or $137.86 to $104.00 to take the train than to drive. Cynthia has to decide if the convenience of having a car in New York City outweighs the additional cost and the disadvantage of being unable to relax and study on the train and the hassle of finding parking in the city. In this example, we focused on identifying the relevant costs and benefits. Everything else was ignored. In the next example, we include all the costs and benefits relevant or not. Nonetheless, we'll still get the correct answer because the irrelevant costs and benefits will cancel out when we compare the alternatives. Reconciling the total and differential approaches. Oak Harbor Woodworks is considering a new labor-saving machine that rents for $3,000 per year. The machine will be used on the company's butcher block production line. Data concerning the company's annual sales and cost of butcher's blocks with and without the new machines are shown below. The next operating income for the product under the two alternatives can be computed as shown in Exhibit 12-1. Note that the net operating income is $12,000 higher with a new machine so that it is the better alternative. Note also that the $12,000 advantage for the new machine can be obtained in two different ways. It is the difference between the $30,000 net operating income with the new machine and the $18,000 net operating income for the current situation. It is also the sum of the differential costs and benefits as shown in the last column of Exhibit 12-1, which is $15,000, $3,000, $12,000. A positive number in the differential cost and benefits column indicates that the difference between the alternatives favors the new machine. A negative number indicates that the difference favors the current situation. A zero in that column simply means that the total amount for the item is exactly the same for both alternatives. Thus, because the difference in the net operating income equals the sum of the difference for the individual items, any cost or benefit that is the same for both alternatives will have no impact on which alternative is preferred. This is the reason that costs and benefits that do not differ between alternatives are irrelevant and can be ignored. If we properly account for them, they will cancel out when we compare the alternatives. Indeed, the only costs that do differ between the alternatives are direct labor cost and the fixed rental cost of the new machine. Hence, the two alternatives can be compared based on only on this relevant cost. Decreased indirect labor cost, which is 5,000 units at a cost savings of $3 per unit, which is $15,000. Less increase in fixed expenses, which is $3,000, and the net annual cost savings from renting the new machine is $12,000. If we focus on just the relevant costs and benefits, we get exactly the same answer as when we listed all of the costs and benefits, including those that do not differ between the alternatives and hence are irrelevant. We get the same answer because the only costs and benefits that matter in the final comparison of the net operating income are those that differ between the two alternatives and hence are not zero in the last column of Exhibit 12-1. Those two relevant costs are both included in the above analysis that quantifies the net advantage of renting the new machine. In using the differential approach is desirable for two reasons. First, only rarely will enough information be available to prepare detailed income statements for both alternatives. Second, mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is really critical. That's all for my report. Next, who will discuss the learning objective number 2 is no other than Miss Lovely Joy Concha.
Thank you to Ms. Balabala. In LO12-2, prepare an analysis showing whether a product line or other business segment should be added or dropped. Decisions relating to whether product lines or other segments of a company should be dropped and new ones added are among the most difficult that a manager has to make. In such decisions, many qualitative and quantitative factors must be considered. Ultimately, however, any final decision to drop a business segment or to add a new one hinge primarily on the impact of decision will have on net operating income. To assess this impact, cost must be carefully analyzed. An illustration of cost analysis. Exhibit 12-2 provides sales and cost information for the preceding month for the discount drug company and its three major product lines: drugs, cosmetics, and housewares. A quick review of this exhibit suggests that dropping the houseware segment would increase the company's overall net operating income by $8,000. However, this would be a flawed conclusion because the data in Exhibit 12-2 do not distinguish between fixed expenses that can be avoided if a product line is dropped and common fixed expenses that cannot be avoided by dropping any particular product line. In this scenario, the two alternatives under consideration are keeping the housewares product line and dropping the housewares product line. Therefore, only those costs that differ between these two alternatives that can be avoided by dropping the housewares product line are relevant. In deciding whether to drop housewares, it is crucial to identify which costs can be avoided and hence are relevant to the decision, and which costs cannot be avoided and hence are relevant. And decision should be analyzed as follows. If the housewares line is dropped, then the company will lose $20,000 per month in contribution margin. But by dropping the line, it may be possible to avoid some fixed costs such as salaries or advertising costs. If dropping the housewares line enables the company to avoid more in fixed cost than it losses in contribution margin, then its overall net operating income will improve the eliminating the product line. On the other hand, if the company is not able to avoid as much in fixed cost as if losses in contribution margin, then the housewares line should be kept. In short, the manager should ask, what cost can I avoid if one drop this product line? To show how to proceed in a product line analysis, suppose that discount drug company has analyzed the fixed cost being charged to the three product lines and determined the following. Number 1. The salaries expense represents salaries paid to employees working directly on the product. All of the employees working in the housewares would be discharged if the product line is dropped. 2. The advertising expense represents advertisements that are specific to each product line and are avoidable if the line is dropped. 3. The utilities expense represents utilities cost for the entire company. The amount charged to each product line is an allocation based on space occupied and is not avoidable if the product line is dropped. 4. The depreciation expense represents depreciation on fixtures used to display the various product lines. Although the fixtures are nearly new, they are cost to build and will have no resale value if the housewares line is dropped. 5. The rent expense represents rent on the entire building housing the company. It is allocated to the product lines on the basis of sales dollars. The monthly rent of 20,000 pesos is fixed under a long-term lease agreement. 6. The insurance expense is for insurance carried on inventories within each of the three product lines. If housewares is dropped, the related inventories will be liquidated and the insurance premiums will decrease proportionately. And in number 7, the general administrative expense represents the cost of accounting, purchasing, and general management, which are allocated to the product lines on the basis of sales dollars. This cost will not change if the housewares line is dropped. A comparative format. This decision can also be approached by preparing comparative income statements showing effect of either keeping or dropping the product line. Exhibit 12-3 contains such an analysis for the discount drug company. As shown in the last column of the exhibit, if the housewares line is dropped, then overall company net operating income will decrease by 5,000 pesos each period. This is the same answer, of course, as we obtained when we focused just on the lost contribution margin and avoidable fixed cost. So this is the exhibit of 12-3, a comparative format for product line analysis. This is the exhibit 12-4, discount drug company product lines recast in contribution format from exhibit 12-2. If the houseware line is dropped, the company will lose the 3,000 pesos segment margin generated by this product line. In addition, we have seen that the 2,000 pesos depreciation of the fixtures is a sunk cost that cannot be avoided. The sum of these two figures, 3,000 pesos plus 2,000 pesos minus 5,000 pesos, would be decrease in the company's overall profits if the housewares line were discontinued. Of course, the company may later choose to drop the product if circumstances change, such as a pending decision to replace the fixtures.
Make or buy analysis. The make or buy decision involves whether to manufacture a product in-house or to purchase it from a third party. The outcome of this analysis should be a decision that maximizes the long-term financial outcome for a company. There are a number of factors to consider when making this decision, including the following items. One of these factors is the cost of item. Which alternative presents the lowest total out-of-pocket cost? Businesses tend to include fixed costs when adding up their internal costs, which is incorrect. Only direct costs should be included in the following compilation of the internal cost. To manufacture a product in-house, this amount should be compared to the quoted price of a supplier. Required expertise. Does the company have sufficient expertise to make the goods in-house? In some cases, a business has experienced such a high rate of product failure that it has no choice but to outsource the work to a supplier. Example. Here is a hypothetical example for coming to a make or buy decision. A reputable skateboard company is now manufacturing the heavy-duty bearing that is utilized in its most liked line of skateboards. The business accounting section reports the following expenses for manufacturing 8,000 units of the bearings internally every year. So we have here direct materials, direct labor, and supervisor salary. So, Jari cost of 6 and 4 pesos, $4. 6 times 8,000 is 48,000. 4 times 8,000 is 32,000. And then sa supervisor salary, lahat na po sila na amount. 6 and 3. 6 times 8,000 equals 48,000. And 3,000 times 8,000 equals 24,000. Next is total expense. 6 times 8,000 is 48,000 na gihapon. 21,000 times 8,000 equals 168,000. So, here is an explanation. An external supplier offered to sell 8,000 bearings to the skateboard company for only $19 per bearing. Should the business is manufacturing the bearings internally or instead purchase them from an external supplier? To arrive at a make or buy decision, the focus should at all times be on the relevant costs, the ones that differ between the alternatives. The expenses that differ between alternatives comprise expenses that could be prevented by buying the bearings from an external supplier. If the expenses that can be avoided by buying bearings from the external supplier amount to less than $19, the businesses must continue to manufacture its bearings and reject the external supplier's offer. On the other hand, if the expenses that can be prevented by buying the bearings from the external supplier amount to more than $19, the external supplier's offer should be accepted. You can use the setup below to manage your applicable avoidable expenses. So, next is total applicable or available expense for making 8,000 units. Direct materials, direct labor, 6 times 48. So, parehara di ay siya gainan. So, ang kalainan ani is walay variable overhead and allocated general overhead. So, 6 times 8,000 equals 48,000. 1 times 8,000 equals 8,000. Allocated general overhead is waya. So, sa 6, 48,000 na gihapon. Tapos, moya sa bigas is relevant. Depreciation of special equipment sa waya 48,000 as is ra gihapon. So, ang total expense is 6 times 8,000 equals 48,000. 14 times 8,000 equals 112,000. The difference of 40,000 supports continuing to make 8,000 units. In conclusion, it may be said that the make or buy decision is a very important decision with respect to overall production strategy, the possible implication for assets, asset levels, employment levels, and key competencies. Business accounting may appear to be an easy set of equation mirroring the money that enters into a business and that which flows out from it. However, in reality, there are countless intricacies associated with the relationship between various kinds of income and costs. Complexity is particularly obvious in make or buy. Considering these aspects, the make or buy decision should be weighed the utmost care.
Prepare an analysis showing whether a special order should accepted. Manager must often evaluate whether a special order should be accepted and if the order is accepted. Special order is one-time order that is not considered part of the company's normal ongoing business. To illustrate, Mountain Goat Cycles has just received a request from the City Police Department to produce 100 specially modified mountain bikes at a price of $558 each. The bikes would be used to patrol some of the more densely populated residential sections of the city. Mountain Goat Cycles can easily modify each city cruiser model to fit the specifications of the Seattle Police. The normal selling price of the city cruiser bikes is $698 and each unit's produced cost is $564 as shown below. Direct materials is $372, then the direct labor is $90, the manufacturing overhead is $102, then the unit product cost is $564. The variables portion of the above manufacturing overhead is $12 per unit. The order would have no effect on the company's total fixed manufacturing overhead costs. The modification requested by the City Police Department consists of welded brackets to hold radius, nightsticks, and other gear. This modification would require $34 in incremental variables costs. In addition, the company would have to pay a graphics design studio which is $2,400 to design and cut the stainless that would be used for the spray painting the City Police Department's logo and other identifying marks on the bikes. This order should have no effect on the company's other sales. The production manager says that she can handle the special order without disrupting any of the company's regular scheduled production. What effect would accepting this order have on the company's net operating income? Only the incremental costs and benefits are relevant because the existing fixed manufacturing overhead costs would not affected by the order. They are not relevant. The incremental net operating income can be computed as follows. The per unit and the total. Incremental revenue is $558 and the total is $555,800 and the less incremental costs. The variable costs, direct material per unit is $372. The total is 337,200. Direct labor is 90 and the total is 9,000. Variable manufacturing overhead is per unit is 12. The total is 1,200. The special modification is 34. The total is 3,400. Total variable cost is $508. Then the total is 50,800. The fixed cost, purchase of stainless is 2,400. Total incremental cost is 53,200. The incremental net operating income is 2,600. Therefore, even though the $558 price on the special order is below normal is 564 unit. Product cost and the order would require additional costs, the order would increase net operating income. In general, a special order is profitable if the incremental revenue from the special order exceeds the incremental cost of the order. However, it is important to make sure that there is an ended idle capacity and that the special order does not cut into normal unit sales or undercut prices on a normal sales. For example, if the company was operating at the capacity, opportunity costs would have to be taken into account, as well as the incremental costs that have already been detailed above. What is constraints? A constraint is anything that prevents you from getting more of what you want. Every individual and every organization faces at least one constraint, so it is not difficult to find example of constraints. You may not have enough time to study thoroughly for every subject and to go out with your friends on the weekend, so time is your constraints. United Airlines has only a limited number of the loading gates available at each BC, Chicago, or Harry hub, so its constraint is loading gates. Vail Resorts has only a limited amount of land to develop as home sites and commercial lots and its sky areas, so its constraint is land. As an example, long waiting periods for the surgery as the chronic problem in the National Health Services. The government-funded provider of the healthcare in the United Kingdom, the diagram in the Exhibit 12-26 illustrates a simplified version of the steps followed by the surgery patient. The number of the patients who can proceed to each steps in a day is indicated in the exhibit. For example, appointment of the outpatient visits can be made for many as 100 referrals from general practitioner in a day. The constraints of the bottleneck in the system is determined by the step that limits total outputs because it has the smallest capacity, in this case surgery. The total number of patients proceed through the entire system cannot exceed 15 per day and the maximum number of the patients who can be treated in surgery. No matter how hard managers, doctors, and nurses try to improve the processing rate elsewhere in the system, they will never succeed in driving down wait lists until the capacity of the surgery is increased. In fact, improvements elsewhere in the system, particularly before the constraints, are likely to result in even longer waiting times and more frustrated patients and healthcare providers. Thus, to be effective, improvement efforts must be focused in the constraints. A business process such as a process of the serving surgery patients is like a chain. If you want to increase the strength of a chain, what is the most effective way to do this? Should you concentrate your efforts on strengthening the strongest link, all links, or the weakest link? Clearly focuses your effort on the weakest link will bring the biggest benefit. The procedures to follow to straighten the chain is clear. First, identify the weakest link, which is the constraints. In the case of the NHS, the constraints is surgery. Second, do not place a greater strain on the system that the weakest link can handle. If you do, the chain will break. In the case of the NHS, more referral that surgery can be accommodated led to the unapplicatively long waiting list. Third, concentrate improvement efforts on the strengthening the weakest link. In the case of the NHS, this means finding ways to increase the number of the surgeries that can be performed in a day. Fourth, if the improvement efforts are successful, eventually the weakest link will improve to the point where it is no longer the weakest link. At the point, the new weakest link must have the identified and improvement efforts must be shifted over to that link. This simple sequential process provides a powerful strategy for the optimizing business processes.
Determine the most profitable use of constrained resource. Contribution margin per unit of the constrained resource. Managers routinely face the problem of deciding how constrained resources are going to be used. A department store, for example, has a limited amount of floor space and therefore cannot stock every product that may be available. A manufacturer has a limited number of machine hours and a limited number of direct labors at its disposal. Because the company can't fully satisfy demand, managers must decide which products or services should be cut back. In other words, managers must decide which products or services make the best use of the constrained resource. Fixed costs are usually unaffected by such choices, so the course of action that will maximize the company's total contribution margin should ordinarily be selected. If some products must be cut back because of a constraint, the key to maximizing the total contribution margin may seem obvious. Favor the products with the highest unit contribution margins. Unfortunately, that is not quite correct. Rather, the correct solution is to favor the products that provide the highest contribution margin per unit of the constrained resource. To illustrate, in addition to its other products, Mountain Goat Cycles makes a saddlebags for bicycles called panniers. These panniers come in two models, a touring model and a mountain model. Cost and revenue data for the two models of panniers are shown below. In order for us to get the contribution margin per unit, we have to subtract the selling price per unit with the variable cost per unit. So we have here the mountain pannier, 25 minus 10, we have $15 for the contribution margin per unit. And for the touring pannier, we have here $12, which is 30 minus 18. And for the contribution margin ratio, we have 60% for the mountain pannier, and for the touring pannier, we have the 40%. The mountain pannier appears to be much more profitable than the touring pannier. It has a $15 per unit contribution margin as compared to only $12 per unit for the touring model, and it has 60% CM ratio as compared to only 40% for the touring model. But now, let us add one more piece of information. The plant that makes the panniers is operating at capacity. This does not mean that every machine and every person in the plant is working at the maximum possible rate, because machines have different capacities. Some machines will be operating at less than 100% of capacity. However, if the plant as a whole cannot produce any more units, some machine or process must be operating at capacity. The machine or process that is limiting overall output is called the bottleneck. It is the constraint. The bottleneck is the constraint. At mountain goat cycles, the bottleneck or the constraint is a stitching machine. The mountain pannier requires 2 minutes of stitching time per unit, and the touring pannier requires 1 minute of stitching time per unit. The stitching machine is available for 12,000 minutes per month, and the company can sell up to 4,000 mountain panniers and 7,000 touring panniers per month. Producing up to this demand for both products would require 15,000 minutes as shown below. Producing up to demand would require 15,000 minutes, but only 12,000 minutes are available. This simply confirms that the stitching machine is the bottleneck by definition because the stitching machine is a bottleneck. The stitching machine does not have enough capacity to satisfy the existing demand for mountain panniers and touring panniers. Therefore, some order for the products will have to be turned down. Naturally, managers will want to know which product is less profitable. To answer this question, they should focus on the contribution margin per unit of the constrained resource. This figure is computed by dividing a product's contribution margin per unit by the amount of the constrained resource required to make a unit of that product. These calculations are carried out below for the mountain and touring panniers. So, makita na siya sa ubos. So, for the contribution margin per unit of the constrained resource, we have $7.50 per minute for the mountain pannier, and for the touring pannier, we have $12 per unit, or per minute rather. It is now easy to decide which product is less profitable and should be de-emphasized. Each minute on the stitching machine that is devoted to the touring pannier results in an increase of $12 in contribution margin and profits. The comparable figure for the mountain pannier is only $7.50 per minute. Therefore, the touring model should be emphasized. Even though the mountain model has the larger contribution margin per unit and a larger CM ratio, the touring model provides the larger contribution margin in relation to the constrained resource. To verify the touring model is indeed the more profitable product, suppose an hour of additional stitching time is available and that unfilled order exists for both products. The additional hour on the stitching machine could be used to make either 30 mountain panniers. So 60 minutes divided by 2 minutes per mountain pannier, or 60 touring panniers. 60 minutes divided by 1 minute per touring pannier. The following profit implications. So we have here the contribution margin per unit and the additional units that can be processed in 1 hour. We have the 30 and the 60 respectively. And it is equal to the additional contribution margin, which is $450 for the mountain pannier and $720 for the touring pannier. Because the additional contribution margin would be $720 for the touring panniers and only $450 for the mountain panniers. The touring panniers make the most profitable use of the company's constrained resource for the stitching machine. The stitching machine is available for 12,000 minutes per month, and producing the touring panniers is the most profitable use of the stitching machine. Therefore, to maximize profits, the company should produce all of the touring panniers. The market will demand 7,000 units and use any remaining capacity to produce mountain panniers. The computation to determine how many mountain panniers can be produced are shown below. Therefore, profit will be maximized by producing 7,000 touring panniers and then using the remaining capacity to produce 2,500 mountain panniers. So we have here the mounted demand for touring panniers, which is 7,000 units, and stitching machine time required to produce one touring pannier 1 minute. So multiply, we have 7,000 minutes, and for the remaining stitching time available, we have to subtract the 12 minutes to the 7,000 minutes. So we have the 5,000 minutes, then divided by 2, which is equal to 2,500 units of mountain panniers. This example clearly shows that looking at each product's unit contribution margin alone is not enough. The contribution margin must be viewed in relation to the amount of the constrained resource each product requires.
Learning objective number 6, determine the value of obtaining more of the constrained resource. So, managing constraints. Effectively managing an organization constraints is the key to increase profits. When a constraints exist in the production process, managers can increase profit by producing the products with the highest contribution margin per unit of the constrained resource. They can also increase profits by increasing the capacity of the bottleneck operation. When a manager increases the capacity of the bottleneck, it is called relaxing or elevating the constraint. In the case of mountain goat cycles, the company is currently working one 8-hour shift to relax the constraint. The stitching machine operator could be asked to work overtime. No one else would have to work overtime because all of the other operations involved in production panniers have excess capacity up to a point, and additional panniers processed through the stitching machine during overtime could be finished during normal working hours and the operations. This number, which was originally stated in terms of minutes in the mountain goat cycles example, is restated below in terms of hours for easier interpretation. The table shown that contribution margin per unit of the constrained resource in minutes of mountain pannier is $7.50 per minute. And the contribution margin per unit of the constrained resource in hours is $450 per hour because $7.50 per minute times 60 minutes per hour equals $450 per hour. The contribution margin per unit of the constrained resource in minutes of touring pannier is $12 per minute. And the contribution margin per unit of the constrained resource in hours is $720 per hour because $12 per minute times 60 minutes per hour equals $720 per hour. If the time were to be used to make additional mountain panniers, it would be worth of $450 per hour. If the time were to be used to make additional touring panniers, it would be worth $720 per hour. In this later case, the company should be willing to pay an overtime premium to the stitching machine operator up to $720 per hour. Suppose, for example, that the stitching machine operator is paid $20 per hour during normal working hours and time and a half, or $30 per hour for overtime. In this case, the premium for overtime is only $10 per hour, whereas in principle, the company should be willing to pay a premium of up to $720 per hour. The difference between what the company should be willing to pay as premium, $720 per hour, and what it would actually have to pay $10 per hour is pure profit of $710 per hour. $710 per hour. To reinforce this concept, suppose that there are only unfilled orders for the mountain pannier. How much would it be worth to the company to run the stitching machine overtime in this situation? Because the additional capacity would be used to make the mountain pannier, the value of that additional capacity would drop to $7.50 per minute or $450 per hour. Nevertheless, the value of relaxing the constraint would still be quite high, and the company should be willing to pay an overtime premium of up to $450 per hour. These calculations indicate that managers should pay great attention at the bottleneck operation. If a bottleneck machine breaks down or is ineffectively utilized, the loss is down due to breakdown or setups. The company losses between $7.50 and $12. The losses on an hourly basis are between $450 and $720. In contrast, there is no such loss of contribution margin if time is lost on a machine that is not a bottleneck. Such machines have excess capacity anyway. Managers should focus much on their attention on managing the bottleneck. As we have discussed, managers should emphasize products that most profitably utilize the constrained resource. They should also make sure that products are processed smoothly through the bottleneck, with minimal lost time due to breakdowns and setups, and they should try to find ways to increase the capacity at the bottleneck. The capacity of the bottleneck can be effectively increased in a number of ways, including working time on the bottleneck, subtracting some of the processing that would be done at the bottleneck, investing in additional machines at the bottleneck, shifting workers from process that are not bottleneck to the process that is bottleneck, focusing business process improvements efforts on the bottleneck, reducing defective units. Each defective unit that is processed through the bottleneck and subsequently scrapped takes the place of a good unit that could have been sold. The last three methods of increasing the capacity of the bottleneck are practically attractive because they are initially free and may even yield additional cost savings. The problem of the multiple constraints. What does a company do if it has more than one potential constraint? For example, a company may have limited raw materials, limited direct labor hours available, limited floor space, and limited advertising dollars to spend on product promotion. How would it determine the right combination of products to produce? The proper combination of or mix of products can be found by use of quantitative method known as linear programming, which is covered in quantitative methods and operations management courses.
Learning objective number 7 is to prepare an analysis showing whether joint products should be sold at the split-off point or processed further. joint product cost, and the contribution approach. In some industries, a number of end products are produced from single raw material input. For example, in the petroleum refining industry, a large number of products are extracted from crude oil, including gasoline, jet fuel, home heating oil, lubricants, asphalt, and various organic chemicals. Another example is provided by the Santa Maria Wool Cooperative of New Mexico. The company buys raw wool from local sheepherds, separates the wool into three grades such as coarse, fine, and superfine, and then dyes the wool using traditional methods that rely on pigments from the local materials. Exhibit 12-7 contains a diagram of the production process. As shown in Exhibit 12-7, Santa Maria Wool Cooperative has two joint costs, such as the cost for wool, which is $200,000, and the separation process, which cost $40,000. And the intermediate products, such as the undyed coarse wool, undyed fine wool, and undyed superfine wool. The sales value for the coarse wool, undyed coarse wool at this point is $120,000. For the undyed fine wool, it has a sales value of $150,000, and for the undyed superfine wool, it has a sales value at this point of $60,000. The separate product cost for the coarse wool is, or for the dyeing cost, is $50,000, and for the fine wool is $6,000, and the dyeing cost for superfine wool is $10,000. Thus, the end products of course, the dyed coarse wool, dyed fine wool, and the dyed superfine wool. And the final sales for the dyed coarse wool is $160,000, and the final sales for the dyed fine wool is $240,000, and the final sale for the dyed superfine wool is $90,000. The pitfalls of allocation. Joint costs are common costs that are incurred to simultaneously produce a variety of end products. These joint costs are often allocated among the different products at the split-off point. A typical approach is to allocate the joint cost according to the relative sales value of the end products. Although allocation of joint product costs is needed for some purposes such as the balance sheet inventory valuation, allocations of this kind are extremely misleading for decision making. Sell or process further decisions. Joint costs are relevant in decisions regarding what to do with the product from the split-off point forward. Once the split-off point is reached, the joint costs have already been incurred and nothing can be done to avoid them. Furthermore, even if the product were disposed of in a landfill without any further processing, all of the joint costs must be incurred to obtain the other products that come out of the joint process. None of the joint costs are avoidable by disposing of any one of the products that emerge from the split-off point. Therefore, none of the joint costs are economically attributable to any one of the intermediate or end products. The joint costs are a common cost of all the intermediate and end products and should not be allocated to them for purpose of making decisions about individual products. To provide a detailed example of the sell or process further decision, return to the data for Santa Maria Wool Cooperative as shown in Exhibit 12-7. We can answer several questions using this data. First, is the company making money if it runs the entire process from beginning to end, assuming that there are no costs other than those displayed in? As shown in Exhibit 12-7, of course, the company is indeed making money as follows. So this is an analysis of the profitability of the overall operation. The combined final sales value is $490,000. We calculate this by adding $160,000 from the $240,000 and the $90,000. Last, the cost of producing the end product, such as the cost of wool, which is $200,000, the cost of separating wool, which is $40,000, and the combined cost of dyeing, which is $120,000. So, we can calculate the total profit by, of course, subtracting the combined final sales from the cost of producing the end product. So $490,000 minus $360,000, so the total profit would be $130,000. Even though the company is making money overall, it may be losing money on one or more of the products. If the company buys wool and runs a separation process, it will get all three intermediate products. Nothing can be done about that. However, each of these products can be sold as is without further processing. It may be that the company would be better off selling one or more of the products prior to dying to avoid dying costs. The appropriate way to make this choice is to compare the incremental revenues to the incremental cost from further processing as follows. So this is an analysis of sell or process further. So for the coarse wool, its final sales value after further processing is $160,000 less the sales value at the split off point, which is $120,000. So its incremental revenue from further processing would be $40,000 less cost of further processing, which is $50,000. So the profit or loss from further processing for the coarse wool would be negative $10,000. And now let's go to the fine wool. Its final sales value after further processing is $240,000 less the sales value at the split off point, which is $150,000. And for the incremental revenue from further processing, it has a $90,000 less the cost of further processing, which is $60,000. So the total profit or loss from further processing for the fine wool is $30,000. And lastly, for the super fine wool, the final sales value after further processing is $90,000 less the sales value at the split off point, which is $60,000. So its total incremental revenue from further processing is $30,000 less the cost of further processing, which is $10,000. So it has a total profit or loss from further processing of $20,000. Activity-based costing and relevant costs. As discussed in an earlier chapter, activity-based costing can be used to help identify potentially relevant costs for decision-making purposes. Activity-based costing improves the traceability of costs by focusing on the activities caused by a product or other segment. However, managers should exercise caution against reading more into this traceability than really exists. People have a tendency to assume that if a cost is traceable to a segment, of course, then the cost is automatically an avoidable cost. That is not true because the costs provided by a well-designed activity-based costing system are only potentially relevant. Before making a decision, of course, manager must still decide which of the potentially relevant costs are actually avoidable. Only those costs that are avoidable are relevant and the others should be ignored. To illustrate, again refer to the data relating to the housewares line in Exhibit 12-4. The $2,000 fixtures depreciation is a traceable cost of the housewares lines because it directly relates to activities in that department. We found, however, that the $2,000 is not avoidable if the houseware line is dropped. The key lesson here is that the method used to assign a cost to a product or other segment does not change the basic nature of the cost. A sunk cost such as the depreciation of old equipment is still a sunk cost regardless of whether it is traced directly to a particular segment. On an activity basis, allocated to all segments on the basis of labor hours or treated in some other way in the costing process. So regardless of the method used to assign costs to products or other segments, the principles discussed in this chapter must be applied to determine the costs that are avoidable in each situation. And for the summary, everything in this chapter consists of applications of one simple but powerful idea. Only those costs and benefits that differ between alternatives are relevant in the decision. All other costs and the benefits are irrelevant and should be ignored. In particular, some costs are relevant, as are future costs that do not differ between alternatives. This simple idea was applied in a variety of situations, including decisions that involve adding or dropping a product line, making or buying a component, accepting or rejecting special order, using constrained resources, and processing a joint product further. This list includes only a small sample of the possible application of the relevant cost concept. Indeed, any decision involving cost hinges on the proper identification and analysis of the costs that are relevant. We will continue to focus on the concepts of a relevant cost in the following chapter with long-term investment decisions are considered. That's all for today. Thank you and God bless.